Chris, last week we had a little bit of a pullback in the S&P 500 off of a record high. Going to deepen it a little bit this morning. How are you viewing this move?
We're off 4% from the highs. This is a modest pullback thus far for a market that's up 17 year to date. I think we're about halfway there. 2790, 2800 is down 6 or 7% from the highs. That's a good shakeout. What I want to watch for, the tactical indicators that tend to show up near market lows, spikes in put calls, spikes in 1 month lows. We're not quite there yet on that stuff. We have about 6-8 weeks of seasonality that's working against us here as well as we look into the future. So I think we've got to hang in here for a couple months, but I think this is corrective. I don't think this is a change in trend.
6 or 7% is roughly what we got in May. Is that correct? So you've had this kind of get up to a new high, pull back. Is there anything to say about the fact that the S&P, if it opened right here, is going to be below last September's high? It seems to sort of trap this breakout to a new high a little bit.
I think we've spent 18 months making almost no price progress, and then over the last 6 weeks, we decisively broke out. I think the odds of another 20% December of 18 or another 8 or 10% May of 2019 is pretty low. We've already had that. I think one of the big differences as we look to 2019, participation actually started to broaden out this year. Take semis, for example. They've been off the playing field for 18 months. They're actually acting pretty well in this environment. So I think the leading market groups that I would look to for signal are saying this is corrective, not a big change.
We see bond yields getting compressed even further. I mean, it seems as if bonds were overbought and overloved even before we got this move well below 2% in the 10-year. Where does it seem like it's going? You
know, there's two things that stand out. Where we look for where the excesses are in this market right now, it is not in the cyclical groups. It is not in the risk-on groups. It's in the low-vol, defensive-oriented sectors. Flows into staples and utilities and REITs have been where the excesses are this year. Now, I think what's interesting, this last leg lower in bond yields from 2 to 175, banks actually haven't really followed them lower, and utilities have not made new relative price highs versus the S&P. So the equity response or the leadership response seems to be a little bit different than I think people would expect with a fresh low in bond yields. If you look at flows into the TLT as well, which is the long bond ETF, they're starting to get pretty aggressive here. So where are the excesses? Where are the excesses in flow? It might be in bonds, not in stocks.
Does that imply that if we do see that pullback back to 2,800 or whatever level on the S&P 500, that we'll see those excesses corrected? Or are we in a stage where we're just going to see the excesses exaggerated? Because pre-market, we're seeing, 2+% declines across the FANG plus names. We're seeing it in all these sort of the risk-on areas and not necessarily in staples and utilities.
Yeah, I think the trouble here for a lot of investors are in an environment where there's some stress, you're not being rewarded for necessarily owning defensive equity groups. You're not being rewarded in terms of relative performance in owning Utes or staples here or even REITs. I think that's the issue. So when we look to what comes out of this on the other side, I would be in favor of a more pro-cyclical sector orientation. I think what's notable is the last couple of weeks, money growth has continued to reaccelerate. So the liquidity backdrop of this market is still pretty decent. M2 reaccelerating, I'd be more inclined on the other side of this to look at groups like semis and home builders and constructions and industrial stocks to come out the other side.